All right, so it appears that we've shifted into the bad news is actually bad news phase of the market, where we got some poor economic data, put a lot of pressure on equities. Not at the beginning of the day, it really kind of hit gear and reversed more towards the European close, middle of the day, and then all the way into the close. So pretty significant reversal today on the markets. Pretty down day, so I'm going to talk about how down it is and whether or not it actually meets kind of our expectations, and what the VIX is doing relative to its seasonal patterns, what our expectations are there. We'll break down some big, significant moves in some of these different asset classes that are pretty telling. A little different. It's a shift. It's a big shift from what we saw last year to what we're seeing so far this year. So I'm going to break that down. What sectors are showing some interesting patterns, and then finally we'll take a look at our trade idea of the day. That's in this industrial type area that's been doing so well during this mid-October rally up till now. And we'll see if we can't look for a bearish idea on that particular trade or stock. So let's go ahead and get started. Today is Wednesday, January the 18th, 2023. This is the market outlook from marketscholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Hit the thumbs up icon to like our video. Comment on anything that stood out to you. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our some of our more popular posts on our blog, as well as our Market Outlook live video. Come down here to the bottom, click that heart. It opens up this tab, hit that like button. Same thing here, click the thumbs up icon. It opens up this tab, hit that like button there. Again, the more you do that, it helps get our content, more likes and shares and retweets and all that. Helps get our content out to all of our followers on those platforms with how their algorithms work. So we really appreciate those who do that day after day, and you can do that right now while you're watching. All right, let's take a look at the S&P 500 with the market forecast indicator here. As you can see, the near-term line has now followed the momentum line down to extreme lows. At least the momentum line at extreme lows. The near-term line is now down in bearish territory. For the first time in a while, it dipped its toe in bearish territory over there when it tried to break that 38% retracement level, the 23% long-term level. Then it's been rallying ever since, but the momentum line didn't come up with the near-term line. So a little bit of a divergence that we've been talking about, and now that's recovering, right? That's starting to recover down there. You can see the market sentiment line and the intermediate line are basically sitting right on top of each other. Technically, the market sentiment line is a smidgen above still the intermediate line, but getting down to extreme lows again doesn't typically happen during bullish trends. Obviously, we've been really volatile here lately, and this has got the looks of in a morning or evening star candlestick pattern. You actually did engulf. Let's see here. The open was at 39.32, so you actually did engulf all four of these bodies. As you can see, we gapped up here. And we closed just barely above that low point. So we closed below these three lows and almost below that one, and engulfed all four bodies. So a pretty significant engulfing pattern. The price, the index is still above its 30-day moving average, but just barely. Never did get above that 2.5% mark, and is now starting to turn lower again. Starting to turn lower here. Pretty bearish day. You can see one of your biggest bearish days that we've had in a while, more than 1%. You have to go back to these 12.17 or 12.15 and 12.16 were the last time that we had this big of a day to the downside or more, and that was right here. These two down days were as big as what we had today. These two right here, number one and number two. Remember, that was a gap down to the downside. So a pretty significant move on the S&P 500 on the market forecast. Remember, the Dow Jones Industrial Average actually fell yesterday. So this is a continuation of yesterday's move. You see the S&P stayed bullish yesterday. The Dow did not. So the Dow actually crossed below its moving average by 0.5%. its near-term line actually got into the reversal zone already because, again, it had the down day yesterday. And the intermediate line is already turning lower. And this would be a really bearish peak for the intermediate line. Already the near-term line, again, got too high for what the momentum line said it should. And the intermediate line is rolling over. Still is below its market sentiment line, never did get back up above it. On the other hand, NASDAQ, which has been relatively bullish here in this past week or so, showing the same divergence pattern here with the near-term line getting well above 90. The momentum line never did. And then, of course, the intermediate line got above the market sentiment line, but still has not reached bullish territory yet. And you can see the engulfing pattern up here, still above the moving average, but just barely. Finally, the Russell 2000. Again, very similar evening star type candlestick pattern here. Pretty significant down day. Momentum line hitting extreme lows. Near-term line you would expect would follow into there like the Dow Jones has, follow into that reversal zone. The intermediate line did get up above 80, so this has had a really good run. You can see you got all the way up to some Fibonacci levels here, the 62% retracement of this intermediate decline that we almost ended the retracement when we broke down below 23% and started a new leg lower, but we obviously didn't hold. So we're still in retracement mode, but we're hitting up against resistance again in the same area and appears to be rolling over to the downside. As of right now, at least, rolling over to the downside. You can see this 38% retracement level goes back to the pre-COVID low. So we broke that support way back over here. We've tested it multiple times since being below it, and now this is the latest time that we've been testing that level. Let's take a look at the weekly chart for the S&P 500. You can see we got a bullish candle still on the week. We are not closing above the 40-week moving average yet. We closed above it for a couple weeks over here. We closed above it for about 3 weeks over here. Closed above it 1 week now, and we're not closing above it yet. The PPO is gotten to where it's almost just barely slightly negative, but you can see the size of the candle again is relatively smaller as we're getting a pretty neutral range here. Looking at the 3 green arrow chart, we've had 3 green arrows for multiple days. The Dow is the first one that's got the red arrow on the moving average. The MACD histogram is peaked and rolling over on all of these indexes and already starting to move. And you can see how close we are to red arrows and the moving averages. More so on the S&P and the Qs, more so than in the Russell 2000. Looking at the 2-line version of this chart, you can see again we failed at the 200-day moving average. Also at these Fibonacci retracement levels, both on this intermediate decline as well as the longer term decline. And then also so far failing at the resistance with the MACD potentially peaking along with the histogram down there, as well as the stochastics also potentially peaking. So you can see how how bullish we've been, and you can see now how not so bullish we are anymore. Like we failed to get above 60. We're already back, coming back down below 100 there. So we'll see, if that goes and moves into anything more. We are back into the cloud, right? We got above the cloud for a few days. We're back into the cloud. We're back below the blue line. We had the beginnings of a weak bullish trend, but we never did get up above 50 here. And now it's, we're not as close to that bullish trend anymore. The McClellan oscillator, which had been so bullish and got all the way up and kind of touched the 100 level. We've also gotten up to this positive 500 level. We'll see if we end up breaking through that or not. Obviously, it's looking like the likelihood is that we will not. The money flow is pretty darn negative. It's still up above 60, so we haven't gotten to bearish territory, but you can see we're near the lows of the year on the money flow indicator itself there. Let's take a look at today's range and today's range and volume. You can see the range was above average, 8.84 points. The volume was also above average at 99 million. So let's look at those averages, or the current levels to their averages. 8.84 points is well up here. So that's more than 2%. More days like that, and we'll get that average to move up above 2% again. And then you can see also the moving. Again, we had 99 million shares trading. That's also above the average, but not extremely above the average. So we're able to stay above that average, which would obviously be bearish and start moving these lines up to the upside. When you look at today at the VIX today, we've been looking for the VIX to start to rally, and has started to rally today in particular. The gap up there on the futures on the open on Tuesday, but you can see the seasonality for the VIX. I've shown you before the correlation here with the VVIX, the correlation with the S&P itself, all these things, and multiple indicators suggesting that we are due for volatility to make a pretty decent run to the upside. Remember how we were so far below. I tweeted out on Friday just how far below the 200-day moving average we were, and now you can see we're starting to work our way back up with getting the close up above the 8-day moving average. So again, some opportunity for that to make a run to the upside and start to fill in some of that gaps up towards the 200-day moving average, which is where I think we're actually headed here on this current intermediate run. All right, now let's take a look at what's driving this price action. And you can see here's a chart from the beginning of the year. So this is so far in January. Long-term bonds are up 9%. International equities are winning as the dollar is down. The dollar down has not necessarily helped commodities. They are bullish. They ended up being positive on the year going into today. They dropped today on the drop in risk appetite, but they're still lagging most other asset classes, including bonds and treasuries, high yield treasuries. But you can see even small cap stocks are outpacing the S&P 500. Even the Qs are outpacing. So this means that your diamonds, your Dow Jones Industrial Average stocks are underperforming. Let's take a look at the chart for bonds and the dollar, because those are the kind of two big drivers right now in the intermarket relationship here. You can see the long-term bonds have been on the bullish trend here. That obviously we're above the 8 and 17-day moving averages. They're both rising. They're about to both cross above the 30-day moving average. And of course, everything is up above the 50, filling in the gap up to the 200-day. Good jump in volume today means that there's probably a good chance that this isn't just a one-day phenomenon. When you look at the weekly chart, here's the real significant move. This is the first time we've been above the 30-week moving average in a year. It's been quite a while, more than a year. It's been quite a while. So this is pretty significant. Now the week's not over with. We still have 2 more days left, but still that's a significant move and significant change. Once you start to fill in the gap between the 50 and the 200-day moving averages, now you're going to have some volume in there, so it's not going to be like one big move to the upside. But you can see how we're starting to fill in. We're starting to be more bullish here. The key level that we've talked about before is this 3.5% mark. So for the most part, when bonds have been dropping, that's been bullish for equities. But we talked about if we drop below 3.5%, that will probably change from being bullish to being bearish for equities. As long as, especially if the Fed is still raising rates. Because again, that kind of shows a strong demand for long-term bonds in the face of short-term bond yields still rising. And we've seen that, right? We've seen the the yield spread between the 10-year and the 2-year jump to 130 basis points now. That's a big spread when you look at the spread between the 2-year and the 3-month here. First of all, you have the 10-year minus the 3-month. This is the historical chart. Where again, being at 132 basis points at the close of yesterday, that's the lowest it's been on record here that the Fed has record of. But when you change this to the 3-month, the 2-year, let's see here. Okay, yes, this is the 2-year minus the 3-month, right? So let me just make sure I have the 2-year minus the 3-month and B minus, okay. We are at 53 basis points on this chart. And again, last time we hit 50 or 49 basis points, the Fed was cutting rates in August of 2019. You can see we hit 51 basis points in February of 07. By September that year, the Fed was cutting rates. The February of 07, the Fed stopped raising rates in June of 06. June of 06 would be right there. The Fed was done cutting rates. So it was after they finished cutting rates that it went negative. And of course, in 2000, December 2000, it got to 78 basis points. By September 2000 or October, we were at 44, and then of course in here, November, we were at 60. The market peaked in September of 06. We started to correct. Obviously, we've already been in the correction mode, but you can see when we get this low, it's led to recession. It's typically led to recession, especially when the Fed is still, despite this. I mean, again, remember the Fed started cutting rates the last time it got this low. The Fed's not cutting rates. The Fed's still widely expected to raise rates to 475 here in a couple weeks. And for that matter, they're still at about a 78% rate expectation. They're still expected to raise rates to 5% in March. And you can see that again reflected in the 3-month. It's not dropping. It's up to it got up to 4.71% yesterday. It's still at 4.67. The 2-year is dropping down to 4.08. The 2-year is saying the Fed is not going to raise rates, and if they do, they will be cutting rates soon, because the 2-year is what front runs the Fed. And typically, if you listen to Jeffrey Gundlach, the Fed follows the 2-year. So this is kind of the first time in a while that the Fed is kind of doing its own thing. At least they are saying they're doing their own thing and not doing what the short-term bond market is telling it to do. Because right now, this is telling the Fed not only not to raise rates here in February, but that they actually should be cutting rates in February to bring the 3-month back down and to get rid of this yield spread, because this is extremely low and just getting lower, especially this spread. 139, 129 basis points on their data point. Doesn't go back as far as the Fed does. I mean, that is by far the lowest yield inversion. Again, when this inversion goes up, when the spread goes back up, that's usually not bullish for equities. So the fact that it's so low means that it's got more to go up at some point in time. And again, there's only 2 ways it goes up. There's only 2 ways it goes up. Either the Fed starts cutting rates, which brings the 3-month down, and this starts to rise, or the 10-year note starts to rise again, which means inflation is still persistent. And I think that is actually less likely. If you look at commodity prices here on a long-term basis, they have been bullish. They had a bullish week last week, but they're still below the 50-week moving average. You could still say that they are still in correction mode. And when commodities correct, that's not bullish for risk appetite. That's actually a reflection of economic expectations declining, even though China is reopening. One more chart to look at is the dollar. If you look at the dollar here, it really broke down last week. It broke the 50-week moving average last week, even with the MACD rising. I think last week's move is kind of one of those fake out type moves. Will ultimately turn out to be one of those fake out type moves, because we've been converging for quite a while. We're still, even though we have broken the point of control, we're still in the value area here. I think we're still in convergence mode. I think this is kind of one of those fake out type moves, kind of a washout, exhaustion type move to the downside. You can see it in some of these other charts too. For example, you see how bullish the euro has been, and you're seeing some divergences. You see this long upper shadow from yesterday. You see it as well in the Japanese yen. The Japanese yen, you can see how bullish, how bearish the dollar has been, how bullish the yen has been, and how we're starting to set up, a base, right, convergence there. And then, of course, the Aussie U.S. dollar, which is a reflection of, again, kind of a reflection of commodities, because Aussie is more correlated with commodities. Look at the reversal pattern we're getting here, right, with the big long upper shadow we got yesterday, very similar to the one we got up here at that peak, a long upper shadow, and then now a continued breakdown so far this morning below the 8-day, and you can see the MACD and stochastics. So I think, again, this is kind of a twofold pattern here, where it shows strength in the dollar, in my opinion, a expected bullish move in the dollar, as well as weakness in commodities, which is a reflection of falling economic growth expectations, even with China reopening. A global drop in demand is, just, in my opinion, expected. Obviously, 2 days doesn't make a trend. As you can see, there's been plenty of 2-day moves to the downside. But if we continue to break down below that 17-day, then you would expect more of a bullish move on the dollar that will have its impact, right? Commodities will have pressure. The gold, which has gone parabolic, will peak, and then the change in risk appetite will probably send this back down, back below that 18,500 level, as stocks like Bed Bath & Beyond, the meme stocks, hit their peak, as they did in other failed rallies that we've had in the past year, and start to work their way back to their previous levels there. Let's take a look at the sector rotation. So bear with me 1 second while I bring up the sector chart. Sector comparison here. And let's just go year to date. Yeah, we'll go one beginning of the year. Sorry, right here. And then we'll go to like this 5. So again, remember, bonds have been the best performing asset class, followed by international equities. Well, if you look at from a year-to-date standpoint, XLC, XLY, XLK have been your best performers, which is not, again, with small cap stocks doing well and international stocks doing well, that's not you would expect that with those three sectors doing well and outperforming, that the S&P would be so bullish. But you can see these industrials, energy, these are the names that have been doing so well off of the October 12th low point, right? So from this point on, they have been doing so well. Industrials, materials, financials, these kind of cyclical areas. Unfortunately, so has real estate and utilities, which are interest rate sensitive areas. They had they are taking advantage of the decline in long-term yields, and you can see how XLY and XLC have had a really good run here year to date, but the main reason why they've had a really good run is because they were the biggest oversold, and so was technology up to a point here. That's not your typical bullish leadership, and we're starting to see that that's why we're not maintaining the bullish move and starting a new long-term bullish move to the upside again. And it looks like another failed attempt, like we've seen multiple times in 2022. All right, when you look at what's been bullish and what was bearish, you can see we don't see this very often, but red across the board, all across the board. There's been a few green spots, including Moderna, which had, again, an earnings release, I believe, that helped push it to the upside. You can see Taiwan Semiconductor, Qualcomm, both had some good moves, but for the most part, chip stocks were down. The big bellwethers were down. Microsoft, Apple down 0.5%, Amazon down 1 3/4%, Google down 0.5%, Facebook down 1 3/4%. You look at some of the big retailers, Walmart and Costco, both down. Those are a couple of names we've looked at in the past. Healthcare stocks outside of Moderna all down pretty big. McDonald's down pretty good. Tech stocks Other tech stocks, Cisco, Visa, and Master are some of the bigger names. Big energy names are all down. I mean, it was across the board moves to the downside. One of the names I wanted to take a look at is actually down here in the industrial space, and that is Deere. Let's take a look at Deere. So, so let's look at this market forecast. I think this is it, but let me just make sure. Okay, yeah, here we go. So Deere had a pretty big breakdown itself, just like the market. Obviously, it's below its moving average, unlike the S&P. So you have the red line there. You have light pink shading as the intermediate line's turning down. The intermediate line had a pullback, right? So we did get briefly into bearish territory, so it was a pullback. And then now here's our pullback bounce, but it's going to look like a failed pullback bounce as we are going to get above 60, but we're already rolling over. The near-term line wasn't very bullish. The momentum line didn't tell it to be very bullish. And now we're down to the momentum line dropping to extreme lows, bringing the near-term line down with it. So, and when you look at that on the two-line chart here, right here, when you look at this on the two-line chart, you can see that we broke the 8 and the 17 and the 30, and the 50 barely at the same time. So a pretty bearish breakdown after after 2-month long, almost 2-month long convergence period. But we're breaking down. Obviously, the MACD had gone slightly positive, but it's rolled over and now is almost negative again. They're both almost below their moving averages. There's a gap in volume down to about 390 to work with here. When you look at some of the other oscillating indicators, you see that the DMI, you got a crossover, so you're back above 20 after a brief drop below it. Here on this little move to the upside, the little move to the upside did not get the positive indicator above 25, and now it's rolling back down. Like I said, you've got the crossover there with the ADX lower. Looking at the RSI and the CCI, you can see the failed peak, which, again, this would be in a bearish range. These are where the peaks typically occur. So again, it's not a good sign that we're rolling over so quickly off of this peak. We're back below the blue and the green lines. We got a negative 26-day rate of change, and then you look at the Bollinger Bands here and the Keltner channels. You can see the bandwidth had broken to a new 152-day low, well off its 150-day high, and that's going to drop down to this peak here in a little bit here pretty soon, but still well off of even that peak inside of the Keltner channels. So you can see we're set up for a breakout move in one direction or the other, and considering the gap in volume here and considering the drop below multiple moving averages, you would expect today's move to work its way down. It's almost in the lowest quartile. If it were to break below this lower band while we're inside of the Keltner channels, then you would expect that we'll probably start to push to the downside here, at least until we get down towards this 390 area. So what I decided to do on this one is to set up a long put vertical spread at the 410. So instead of buying the at the money strike, which at the time it was at the money, now the 420 is at the money. When we bought this, again at the Market Outlook Live, which is what, at 3:30 Eastern time, we were trading at 429, so we're already down to 426, and we're down even lower here in the pre-market. So now this is the at the money, but at the time I bought the at the money, I bought one strike away from the at the money, which is 420, and then sold the 410. So you can see it's already working in our favor here a little bit since we got into it, and it's got to get down. Remember, 390 is where that volume starts to kick in. So as long as we get below 410 and stay there for a smaller amount of risk, I can get at least double the reward by putting this vertical on. And again, if it does break back up above these moving averages, then I know that it was, again, more of a failed attempt to the downside, and it gets back up above this, we can take a couple $100 loss instead and get out a little earlier instead of waiting for it to get all the way down to the $600 loss. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out on the top right corner of your screen. That takes you to our Market Outlook forums. open up any new thread with any questions or comments you have, or reply to anybody else's thread, and let's keep this conversation going in between the videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join our website at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.